Welcome to MBA 620, Financial Decision Making. My name is Dr. Richard Works, and I will be your instructor for this course. This lesson will discuss Project 2, Accounting for Managers. Step 1 of this project will be to review financial statements. An accounting transaction is a business activity or event that causes a measurable change in the accounting equation. An exchange of cash for merchandise is a transaction. However, merely placing an order for goods is not a recordable transaction because no exchange has taken place. A chart of accounts will have specific types of accounts that business activities fall into. These include assets, which are what the business owns, liabilities, which are what the business owes to others, and the equity, which is the difference between the assets and the liabilities, or what it owes to the owners. These are the building blocks for the basic accounting equation. Therefore, your assets equal your liabilities plus your equity. The income statement, sometimes called the earnings statement or profit and loss statement. This statement reports the profitability of a business organization for a stated period of time. In accounting, we measure profitability for a period such as a month, a year, or a quarter by comparing the revenues earned with the expenses incurred to produce these revenues. This is the first financial statement prepared because you would need the information from this statement for the remaining statements. The income statements contains three things: revenues, which are the inflows of cash resulting from the sale of products or the rendering of services to customers. We measure revenue by the prices agreed on in the exchanges in which a business delivers goods or renders services. Expenses are the costs incurred to produce revenues. Expenses are cost of doing business, typically identified as accounts ending with the word expense. Lastly, net income. Net income is often called the earnings of the company. When expenses exceeds revenues, the business has a net loss. Therefore, your formula for this income statement is revenues minus expenses equals net income. And here we see a net income example. So this is a hypothetical company, Chris's Landscaping. This is the income statement for the month ending in August 31st, 2020. We see that the total revenue for the month was $1,400. In order to make this $1,400, Chris had to spend $100 on a tractor brake repair. He had to spend $50 on tractor fuel, and he had to spend $1,000 on business insurance. Therefore, to make that $1,400, Chris had to spend $1,150. So the net income is $1,400 minus $1,150, which will be $250. The primary purpose of a balance sheet is to report an organization's assets and liabilities at a particular point in time. The format is quite simple. All assets are listed first, usually in order of liquidity, followed by the liabilities. A picture is provided of each future economic benefit owned or controlled by the company, its assets, as well as its debts or liabilities. The balance sheet shows the company's financial condition on one specific date. All other financial statements report events occurring over a period of time, such as a year or a quarter. But the balance sheet discloses assets and liabilities as of the one specified date. The balance sheet will always balance unless a mistake is made. The equation for your balance sheet is assets equals liabilities plus stockholders' equity. Here we have a balance sheet example. So this is Cheesy Chuck's Classic Corn, the balance sheet as of June the 30th, 2018. On your left-hand side, we have the assets. We have the cash, which is $6,200, and then we have the equipment. If they were to sell their equipment today, it would be $12,500. So as of June the 30th, 2018, their total assets is $18,700. On the right-hand side, we have the liabilities, which includes the accounts payable, and according to this one, that they owe $650 to someone or a company or something, and then also the wages payable. And for this month, they owe $1,200 to the people that work there. So therefore, we have the total assets. Now, if you take the total assets minus the total liabilities, you will get $16,850, which is what will be owed to the owners. So that would be your owner's equity. And as you see here, the bottom lines of both the right and left side have to equal. The statement of cash flows is one of your 4 primary financial reports that is used to evaluate a company's operating performance. Primary financial reports include the income statement, balance sheet, retained earnings report, and the statement of cash flows. The statement of cash flows is organized into 3 types of cash flows: operating cash flow, investing cash flow, and financing cash flow. This financial statement is a financial snapshot of a company's performance based on the operating, investing, and financing cash flows. Here we have an example of a statement of cash flows, and I will pause for a moment to give you a chance to review this document. Understanding how to read corporate financials. Publicly traded companies are required to file financial and other informational reports to the Securities and Exchange Commission, a federal regulatory agency that regulates corporations with shares listed and traded on security exchanges through required periodic filings. The SEC accomplishes this in 2 primary ways: issuing regulations and providing oversight of financial markets. The goal of these actions is to help ensure that businesses provide investors with access to transparent and unbiased financial information. Visit sec.gov to find financial and non-financial data on publicly traded companies if you would like. Horizontal analysis, also known as trend analysis, includes comparisons made to a select base year or period. Trend percentages are useful for comparing financial statements over several years because they disclose changes in trends occurring through time, especially compared to the previous year. And when we are doing our horizontal analysis, we are looking at creating 2 columns of data. One is the dollar change, which is subtracting the old dollar value from the new dollar value. And the second is the percent change. Now for percent change, we will be calculating this as new divided by old minus 1. And here is an example of horizontal analysis. If you can see, we can do this for income statements and also balance sheets. So basically what you are doing, for example, today I have my current year as of right now for both the income statement and the balance sheets. And then I compare my current year with the previous year. And what I'm doing is creating 2 additional columns to the right. One's the dollar change, it's the difference between those values, and the other is the percent change. And that is how I would do my horizontal analysis. Step 2 in the project is evaluate business performance using ratio analysis. Financial accounting ratios. Ratio analysis is one of the most important tools for evaluating a company's financial health. It's not just about calculating ratios, it's about interpreting the ratios and seeing changes, opportunities, and threats. Ratios are only as good as the mind that analyzes these ratios. First, we have liquidity ratios. These measure the ability of a business to meet its short-term financial obligations. These ratios are associated with a firm's working capital. Next, we have debt management ratios. These measure how much a firm uses debt as a source of financing. These are also referred to as equity or solvency ratios. When a company uses debt financing, they use other people's money to finance their business activities. Next, we have profitability ratios. We love to focus on profit, the so-called bottom line. So ratio analysis helps us to put our profit number into context. These ratios used together can help give a clear picture of the profitability of a firm. Then we have market value ratios, also called investment valuation ratios. These relate a firm's value as measured by stock price to other accounting measures, such as earnings and cash flow. These are a way to measure the value of a company's stock relative to another company's stock. For business performance ratios, first we have the current ratio. The current ratio is working capital expressed as a ratio. The current ratio considers the amount of current assets available to cover current liabilities. The higher the current ratio, the more likely the company can cover its short-term debts. The formula for your current ratio is current assets divided by current liabilities. Market debt ratio is a solvency ratio that measures the proportion of a book value of a company's debt to the sum of the book value of its debt and the market value of its equity. Net profit margin is a percentage of each sales dollar that remains after all expenses have been deducted, including interest, taxes, and preferred stock dividends. Therefore, our formula for this is net profit margin equals net income divided by sales or revenues times 100. Earnings power is a business's ability to generate profit from conducting its operations. It is used to analyze stocks to assess whether the underlying company is worth of investment. The formula for this is basic earnings power equals EBIT divided by total assets. And if you're unaware, EBIT is earnings before interest and taxes. Days sales outstanding is a measure of the average number of days that it takes for a company to collect payment after a sale has been made. The formula for the days sales outstanding is equal to the accounts receivable divided by the average sales per day. Financial ratios and firm performance. Liquidity ratios. These indicate a firm's ability to pay short-term obligations with short-term assets without endangering the firm. In general, higher ratios are a favorable indicator. The first liquidity ratio is the current ratio, and you calculate that by current assets divided by current liabilities. And then the second is the quick ratio, and you calculate that by taking your current assets, subtracting the inventory, and then whatever your ending value is, divide that by your current liabilities. Next, we have efficiency ratios. These indicate a firm's ability to use assets to produce sales. These are also called turnover ratios. In general, higher numbers are a favorable indicator. The inventory turnover ratio is calculated by cost of goods sold divided by inventory. And then the total asset turnover is calculated by net sales divided by total assets. For the efficiency ratio, a lower number is generally a positive signal. So the days sales in inventory equals 365 divided by your inventory turnover. Leverage ratios or debt ratios indicate whether a firm is using the appropriate amount of debt financing. In general, higher ratios indicate greater potential return, but also greater bankruptcy risk. The formula for total debt ratio is total debt divided by total assets. And then the formula for debt to equity ratio is total debt divided by total equity. The profitability ratios indicate whether a firm is generating adequate profit from its assets. In general, higher ratios indicate better performance. The net profit margin ratio is calculated as net income divided by net sales. The return on assets ratio is calculated by net income divided by total assets. And then the return on equity is calculated by net income divided by total equity. Next, we have market value ratios. These indicate how a market values the firm's equity. Higher ratios are generally better for shareholder wealth. So your price to earnings ratio is calculated by price per share divided by earnings per share. And then your market to book ratio is calculated by price per share divided by the book value of equity per share. The DuPont equation is a measure for return on equity, and it is calculated by multiplying three variables. First, your profit margin, which you get when you take your net income divided by your net sales. Second is your total asset turnover, which you get when you take your net sales divided by your total assets. And then third is the equity multiplier, which you get when you take your total assets divided by your total equity. This equation shows that the return on equity is driven by profitability, operating efficiency, and the amount of debt or leverage. Next, we come to step 3 in your project, which is to participate in the discussions of accounting ethics. Since 1973, the primary authoritative body in charge of producing U.S. generally accepted accounting principles, otherwise known as GAAP, has been the Financial Accounting Standards Board, FASB. FASB is an independent group supported by the U.S. government, various accounting organizations, and private businesses. It is charged with establishing and improving the standards by which businesses and nonprofit organizations produce the financial information that they distribute to decision makers. Typically, accounting problems arise over time within various areas of financial reporting. New types of financial events can be created that are not covered by GAAP, or perhaps weaknesses in earlier rules start to become evident. If such issues grow to be serious, FASB will step in and study these issues and pass new rules or make amendments to the previous one. FASB is methodical in its deliberations, and the entire process can take years. Changes, additions, and deletions to GAAP are not made without proper consideration. To achieve basic objectives and implement fundamental qualities, the U.S. generally accepted accounting principles have 4 basic principles and 4 basic constraints. Historical cost principle. This requires companies to account and report based on acquisition cost rather than fair market value for most assets and liabilities. This principle behaves companies to provide information that is reliable, removing opportunity to provide subjective and potentially biased market values. Thus, there is a trend to use fair values. Most debt and securities are now reported at market values. Revenue recognition principle. This holds that companies may not record revenue until 1. It is realized or realizable, and 2. It is earned. It does not matter if the cash has been received or paid. This is the essence of the accrual-based accounting. If a company or business believes that they may not receive payment for services or goods rendered, they may not record related revenue. Matching principle. This holds that expenses have to be matched with revenue as long as it is reasonable to do so. Expenses are recognized not when the work is performed or when a product is produced, but when the work has been done or the product has been delivered. Only if no connection with revenue can be established, costs may be charged as expenses to the current period. This principle allows greater evaluation of actual profitability and performance, and it shows how much was spent to earn revenue. Full disclosure principle. This holds that the amount and kinds of information disclosed should be decided based on trade-off analysis, as a larger amount of information costs more to prepare and use. Information disclosed should be enough to make a judgment while keeping costs reasonable. Information is presented in the main body of financial statements, in the notes, or as supplemental information. International Financial Reporting Standards. The International Accounting Standards Board is a major entity proposing international standards of accounting. The purpose of accounting is to communicate the organization's financial position to a company's managers, investors, banks, and the government. Accounting standards are a system of rules and principles that prescribe the format and content of financial statements. Through this consistent reporting, a firm's managers and investors can assess the financial health of the firm. Accounting standards cover topics such as how to account for inventories, depreciation, research and development costs, income taxes, investments, intangible assets, and employee benefits. Investors and banks use these financial statements to determine whether to invest in or loan capital to the firm, while governments use these statements to ensure that the companies are paying their fair share of taxes. As countries develop different cultures, languages, and social and economic traditions, they develop different accounting practices as well. In an increasingly globalized world, however, these differences are not optimal for smooth functioning of international business. Sarbanes-Oxley Act of 2002. The U.S. Congress passed the Sarbanes-Oxley Act of 2002 on July the 30th of that year to help protect investors from fraudulent financial reportings by corporations. Also known as the SOX Act of 2002 and the Corporate Responsibility Act of 2002, it mandated strict reforms to existing securities regulations and imposed tough new penalties on lawbreakers. Next, we come to step 4 of our project, which is to prepare the executive summary. An executive summary is a brief document typically directed at top-level managers who sometimes make decisions based on a reading of this summary alone. As a result, the executive summary must be concise but comprehensive, and it must include the purpose, the problem, the method of analyzing the problem, the results of the analysis, and the recommendations. And here are the references available for this particular lesson. Feel free to pause and look more in detail if you would like. And that is the end of this lesson. Thank you.